So, welcome everybody to Tale of Three Cities. I'm Brad Smith with MCM CPAs and Advisors, based here in Louisville, Kentucky. I currently serve as the chair of ACG Kentucky, and I'm going to try to moderate us through today's session. Special thanks to our respective chapters from Kentucky, Tennessee, and Cincinnati for joining in today. So just quickly, we want to recognize our great sponsors in each of our chapters. Without their continued support across all our chapters, our respective chapters wouldn't be able to do what we do in the market. So thanks to that, the long time, most of these sponsors across, I know all three of our chapters have been longtime supporters of ACG in their respective markets and in the broader market of the ACG ecosystem. So today, the goal is to go through a panel discussion. We've got a representative from each of our markets. They come from different sectors within our ecosystem, and they're going to share their insights and perspectives across a couple of areas. So with that, we'll jump into the process and get a chance for you to meet our panelists today. And I'm just going to ask the three of them to give a brief introduction about their background and their role in the ecosystem which ACG is meant to support. So, John Sweeney, I'll come to you first to kick us off.
Hi, this is John Sweeney. I'm John Sweeney with Baird Business Owner Solutions. Formerly, we were Hilliard Lyons Investment Banking. You all may remember us in the lower middle market investment banking arena in the past. We were, our entire company, Hilliard Lyons, was purchased last year by Baird. At the time, we were right at about $50 billion in assets under management. We had about 400 FAs in 12 states, and that was primarily what Baird was interested in, the private wealth management arm. They were happy, however, to have stumbled upon the fact that they inherited a smaller investment bank, given that they are really these days reaching into the upper middle market and doing a lot more sort of private equity to private equity transactions, not as much of the sort of tip of the spear stuff that we have been working on sort of for the last, call it, 15 years since we were B Catalyst. So that has worked out well. As a result of our being purchased by Baird, we now have an audience of almost 1,400 FAs. Those are financial associates who are dealing with the private wealth management aspect of their clients' portfolios, mostly stocks and bonds, obviously, but they've also got privately held companies in those portfolios. And as a result, we make a good fit for that group, especially given that our big brothers in Chicago, global investment banking, have somewhat gone out of that universe of sort of the sub 150 million and below market. So we are, as we always have been, really concentrating on that sort of, call it 3 to 15 to maybe even 20 million EBITDA company, but mostly very closely held, first shot at the private equity market. And as usual, we are very much evangelists, we like to say, for the private equity community. We very much, especially if we have a younger growing company, we very much try to introduce them into the aspects of the beneficial aspects of being purchased by a private equity group in the call it recap type of a transaction, and that has been, frankly, that's been very successful for us and for our clients. So that has been we've been able to reinforce that evangelism, so to speak, and would like to continue doing that as we move forward with Baird. And I think it's worked really well. We are right now the busiest we've ever been. And it's part of that is due to our new friends, but part of it is I also think of the environment, which we'll probably talk a little bit more about today.
Thanks, John. Barry Peterson.
Well, hello, everyone. I am Barry Peterson. I'm one of the co-founders of North Creek Mezzanine. We're a mezzanine debt and equity investor, now operating out of our third SBIC fund. In total, we have about $500 million under management. Our most recent fund, Fund 3, we raised in September of 2019, so last year. We look to make debt and equity investments from $1 to $12 million in lower middle market companies. Since 2010, we've made investments now in 57 companies all across the United States. We don't have any industry focus or bias. We're really generalists. We make investments in both sponsor-led and invest directly with companies seeking more patient long-term capital. So that's our story. I'll pass it to Lamar.
Great. Thanks, Barry. Lamar, close us out with introductions.
Sure. Hello, everyone. I'm with GenCap America, based here in Nashville, and we have a long track record as a lower middle market private equity firm making control investments in companies throughout the United States, and really that 2 to 10 million of EBITDA range. And what we've done and been remarkably consistent with since the very early days of GenCap in the late 80s all the way to today in Fund 7 is we focus on two things, really. One, stability of cash flow, which is not unique in the private equity world, but two, all of our deals take on the look of a management buyout. So we always back an internal team that exists currently within the company to either cash out the owner or let them step back considerably or stay in the business. But what's important to us is that heir apparent is designated. So we generally describe our industry focus as manufacturing, distribution, and basic service companies, but we're much broader than that. Unfortunately, there's no SIC code for management team in place, so we have to cast a pretty wide net. But I think that's all about us.
Great. Thanks, Lamar. So you can see, we've got a great diversity on the panel, and they'll share different insights and go back maybe as a starting point, a jumping off point, something that John Sweeney mentioned, that he's the busiest and their group's the busiest that he can remember. And so let's start at a macro level, and I'll come back. Maybe Lamar, I'll start with you. Give me your perspective and the group's perspective of the COVID impact on the macro environment, either activity level, specific sectors, kind of macro view from the GenCap perspective.
Well, I will echo what John said. At the beginning of the year, I felt like I was to some degree responsible for our fate because I was reporting to everyone in February that I anticipated 2020 to be a record year in terms of deal flow for us. And then we fell off a cliff, obviously, as the country locked down in April and May. But with that said, we have rebounded considerably. GenCap as a firm, we've exited one deal and acquired two platform companies since really May. So, and then I actually just pulled the numbers. I was going to look at this, but from a deal flow perspective, we're about 20% off where we were in 2019, which was a record deal flow year for us. So that's pretty remarkable considering April and May were pretty well shot. Deal flow came to a trickle. So we're pretty happy about where we are, and we're pretty optimistic generally for the rest of the year. Cautiously optimistic, I should say. There seems there's always a new threat, whether it's a murder hornet or a pandemic, but for now things look pretty good.
All right, let's build on that. And John, I'll come to you and maybe build on your earlier comments about your all's deal flow and activity levels.
Yeah, and I think I would echo sort of what Lamar was saying in that it's been an incredibly crazy year. I mean, we were right on the cusp of getting a deal closed, thank goodness, which has been announced, the Barricades Unlimited deal out in Texas, which was brought to us much earlier in 2019 by a Baird FA. But that got very touch and go. It was a very well organized process. We had a lot of very, very interested bidders. Multiples were very high, and to the LOI stage, and all of a sudden, COVID came, and there was all kinds of extra risk appended to the deal. We had to get in there and really sort of renegotiate and maintain our pricing and everything else. And it wasn't the easiest thing in the world, but I think we got a very good deal done that was beneficial really to both parties. Our seller was very confident in his company to the point where he said he'd take more equity in order to maintain the pricing. So it was a good outcome, and I think it's going to really work out for him in the end. When he exits. Going forward, we had a bunch of stuff that just got suspended. So, as Lamar said, for that sort of 2-month period, a lot of stuff was just in the air. But then, May, June, it was like the flood started, and everybody really was intending to get out. And I'm not sure if some of it wasn't the election issues that we're running into, that the possibility of higher capital gains upon exit. But we got deals coming in from all sides, and it was an interesting sort of barbell. You had some clients who were not very enthused about the numbers that they were seeing, and saying, hey, maybe this is a better time to get out because 2021 may be even worse than what we're seeing right now because of COVID. And then on the other hand, we had a bunch of clients who are having their best years ever because a lot of them have some sort of a DTC aspect. And as you all know, the pickup on the e-commerce side has really improved those particular sellers that had an expertise in that area. So it's been a very odd sort of group of companies going to market, some on a very, very strong foot and others not so much. But it looks like it's going to be a pretty mad scramble through to December here.
And Barry, your perspective from North Creek?
Yeah, not surprisingly, our experience is very similar to Lamar and John. We started out the year very strong. We closed a couple of investments, and then everything went quiet and dropped off the table. To put it in perspective, in 2019, we looked at 300 transactions through July, and this year we looked at 198. So activity's off by about a third, so a little more than Lamar. We've issued 11 term sheets this year versus 27 last year through July, and we issued no term sheets from March to July. So we have seen activity levels pick up over the last couple of months, and our deal flow has picked up, but there was a period where really there was not much to look at. Over this period, we have seen some activity in the space where I think companies have been less impacted by COVID. So we've had one company refinance a retail and commercial floor space provider. So I think benefiting from the stay at home, everybody wants to improve their surroundings. We've had 3 portfolio companies sell, one in the janitorial and maintenance business, one in the direct-to-consumer business, and one in medical. So businesses where there hasn't been much of an impact of COVID, or perhaps maybe some increase in demand, there clearly is interest and activity. On the out of favor side, I would say that anything travel, hospitality, restaurant, brick and mortar retail, or aerospace is really struggling from our perspective.
Good. So let's maybe take a next step down. It sounds like collectively you all saw a press pause for about 60 days. That's come out. We're back active, deal flow, deal volume, stronger as ever. We see that maybe continuing at least through the end of the year, at least optimistically thinking that. So let's talk about the impact of structure and the deal, what this environment has done and what you're seeing those changes be. And Lamar, I see you up on the screen, so I'm going to come to you first and maybe talk a little bit of, are you seeing any changes? Have you seen changes in how deals are being structured, either around earnouts or seller notes, cash, any of those elements, or anything that we didn't mention there?
Yeah, so I'll first give a caveat and say we have not really seen yet the deeply impacted. There's been a lot of talk about the COVID add back. We have not yet seen those deals. I feel like a lot of folks are holding those and letting them prove out over time that the company is either recovering or trying to get an understanding of what the new normal cash flow level is. So there hasn't been a whole lot of discussion around the debate around a COVID add back for the deals that we've been looking at. That said, there has been a lot of discussion around earnouts becoming part of the new normal. We as a firm have not been a big proponent of earnouts in the past. Frankly, we just feel like today's earnout is tomorrow's potential litigation, so we try and avoid it. But we do anticipate some time going forward, call it 4Q of this year, when those debates are going to heat up, where a business owner says that the company will absolutely recover to this point, and we are looking at 2 quarters of data, obviously COVID impacted, that show that it's off that number, and we're gonna have to find a way to do it. Now, how we structure that, I think that's what we're gonna have a lot of discussion here about. Where does the earnout period start and end? What are we measuring, revenue versus EBITDA? And then as a firm who has not done these in the past, if we did anticipate going down this road, we want to get very, structured about what is included and what can we do inside the company. We don't want to be hamstrung by a seller on the impacts or the changes that we can make inside of a company to, potentially let it grow further.
John, from your perspective, anything to add, like around the earnout structure, and maybe if there's not, or if there is, maybe bleed that into one of the things you mentioned in your opening comments is around pricing and valuation. Maybe talk a little bit about your experience and what you are seeing in that regard.
Well, we're still a little early in on some of these deals, but again, there's that barbell aspect where certain deals I think are going to look more more attractive and are going to have stronger pricing perhaps even than they would have because of the scarcity aspect of what's out there. But just going quickly back to your earlier question, we have not really seen much structural change. I think what we have heard from people is that COVID is going to be an add back, that it's, that people are going to disregard it because it's occurred to everybody. I look at that with a little bit of a jaundiced eye. I think there's at least going to be some, incorporation of that risk going forward. So we'll see how that falls out. But with regard to our stronger companies, these DTC groups that are out there now, I think if anything, they are going to be some of the strongest deals of the year. And, I don't expect that there'll be much impact at all. Because frankly, these guys are doing better right now because their competitors are not dealing with COVID as well as they are, thanks to their distribution channels.
And has that caused any changes in the potential buyer pool that you've seen, John?
Not so much. I mean, the strategics are always going to sort of be the same. I mean, some of them are obviously less well equipped than others. But the sophisticated private equity groups have really, I think, gotten their arms around this relatively quickly and have really looked to see kind of what the opportunity is in this event more than the risk. I mean, I think they still are incorporating the risk, but I think, they're able to sort of put a fence around it as well.
All right. Barry, talk a little bit about the financing structure that you are seeing. Again, it could be we're kind of early into the process. I understand that, but what are you all talking about? What are you all envisioning about potential changes around the whole financing structure between senior, mezzanine, and equity?
Yeah, I would say it is still early, but I would say that I think most senior lenders today are becoming or have become more internally focused, looking at dealing with PPP loans and dealing with covenant related issues. June covenants generally get reported to the bank 30 to 45 days later. So just dealing with those covenant issues, we fully expect leverage levels to come down. I just saw a Fed survey of senior credit officers that showed that 80% of all the respondents to the Fed survey reported a tightening of standards for commercial and industrial loans. The last time it even approached that level was 08 and 09. And then further, 60% of all of those respondents reported increasing spreads on loan rates. So it's our expectation that we will see, it's certainly in the lower end of the middle market, a half to one turn less senior leverage availability. And as a result, I think you'll see corresponding overall leverage come down a half to at least a turn.
Lamar, any experience from your all seat on valuation and multiples?
I hate to sound like a broken record here with John and Barry, but they describe the two things that we've seen that have been pretty notable. Is one, the quality assets, the companies that have not really been impacted by COVID terribly throughout this period, if anything, their multiples might be increasing just because there remain to be a lot of private equity funds out there like us that have dry powder that just can't take a year off from investing. So because the amount of deals that are hitting the market is so few, there's just disparity in supply and demand. So the demand for those companies is higher. And then to echo what Barry said, I mean, generally our expectation is, and I don't have great data to prove this, just anecdotal conversations we've had around deals with lenders, is that there has been some general tightening around not only the amount of leverage offered, but also covenants around that debt. It's just I won't say more difficult conversation, but a more detailed conversation than it was might have been in January for some of the deals that we've looked at.
All right, so let's kind of keep working down the chain here from the standpoint of, so we've talked about deal flow, we've talked about structure, let's talk about process and what you are seeing or even envisioning, again, because each of you have said we're still kind of early on in the process. So my guess is these discussions are going on in each of your all's shops around process changes, expectation of what that looks like. So let's start with due diligence, and maybe Lamar, I'll stay with you and give me some thoughts around how you all see and what you've seen so far in changes to the due diligence process.
Well, they have been significant. For the two deals that we closed, I can talk to those specifically and say in both cases, there was a call it pre-management meeting that occurred over Zoom. And then my impression was that was a bigger group. And then the intermediary that was running the process whittled that down to a smaller group, call it 2 or 3 groups that came for in-person meetings. So we did get the in-person meeting there and then one other later, but none of our service providers visited either company. So that is significant because that's just not something that we love, frankly. Being a firm that, we have so much weight on the management team that we're backing. That's such a critical part of our process that the more opportunities, more touch points that we have with that group, the better, so we can get a better feel for, who are the critical pieces and how do they work and how do they think about the business. So, is that sustainable? I don't know. It worked for 2 deals. But we also think that even for the Q of E's, our preference would be to get those guys back sooner than later, just because there are certain things that you can pick up on a plant tour that you just can't, you're never going to get over Zoom or on an edited YouTube video about the company. So for now, it's light touch. And also on the process point too, something else that's come up here that I've noticed in our questioning around the investment team discussions is we're really sensitive to things that happened during that April-May or March-April-May timeframe. As we all know, all the companies that we invest in the lower middle market, there are oscillations all the time, and some of them are explainable by simple things that happened in the company. It can be as simple as this guy got sick or not even COVID related, I should say, someone was absent or what have you. But we are going to really dig in on this period and try and figure out what the actual impacts were of COVID so that we can, ascertain, no, that was a COVID-related incident. It wasn't a meaningful change in the business that we're later going to have to deal with, type of thing.
And did you all see, you talked about 2 deals that you closed. Did you see a refinement in your own processes between deal 1 and deal 2 to kind of learn from kind of what the new world looked like and get better?
We did. I'm trying to think of a specific example that we did it. I think both were relatively late in the period. So the world generally, I mean, this webinar is a great example of how everyone's just gotten better at Zoom. And so it was a little less unconventional to try and do all these things. And everyone was in agreement that this was the right way. But I bet, you know, if you looked back, our questionnaire and kind of how we asked questions got a little bit more precise just because we knew there was no expectation that we were going to get multiple visits and that type of thing. So our phone calls probably got a little bit longer and you know, we felt a little bit more comfortable asking things remotely that we probably would have saved for in-person discussions in other circumstances.
Right. John, maybe you'll take that as a jumping off point and talk a little bit about your all's experience around this process area and what you're seeing and what you anticipate seeing for the rest of the year.
Yeah, no, it's interesting as we were discussing this morning going on out west, and there are certain buyers that are international, and our parent company, this is a spinoff of a larger group, concerned that there would not be an equal playing field because folks from Germany and France are not going to be able to come and see this thing. So we're trying to really sort of figure out how we can fairly, you know, adjudicate that issue, you know. But I'm with Lamar, and we really stress this, especially not so much with this particular company because it's a corporate spinoff, but with our traditional client base, which is that family-owned, you know, a closely held, entrepreneur-owned company, we really put a lot of, you know, effort into making sure that the fit is correct, and therefore we really want to have up-close personal meetings, dinners, you know, those types of things. We really get to know the person or the group, and we don't think that Zoom can replace that aspect of it. So. You know, we're going to continue to try to involve some of these Zoom aspects, which are helpful. You know, as Lamar said, we're doing more what were traditionally Q&A calls that we might have prior to a management meeting. We're now doing those on Zoom, so that's helped a little bit. You know, and you know, it's all evolving at breakneck pace. But we hope that this, you know, the person-to-person aspect does not go by the wayside, because we think it's critical to putting together a deal that has a fit as well as a financial, you know, equitable aspect to it.
Barry, things to add there?
I would totally agree with Lamar. We at North Creek have a policy. We have to go see a company and meet the management team in person. I don't think there's anything like pouring a few drinks in someone and see how they behave. And so the one add-on acquisition that we closed for a portfolio company, I actually did fly to a management meeting, but interestingly, the bank lender in the deal chose to attend virtually, so did not physically attend. And I think over time, people get more comfortable with in-person meetings. But again, we're not going to close a transaction unless we see the business and meet the management team in person. I will agree with John that the virtual Zoom meetings that we've had more of those with management teams, which it's always good to see, you know, people in person on video. And I think that's been a positive, but nothing like seeing people in person.
Maybe we'll divert here. We had a question in the chat. It's kind of a two-part question, and first one I'll come to maybe John Sweeney on. And the question from Milton was, are you finding founders wanting to seek excess evaluations? Is that any different than was the case pre-COVID?
Yeah, certainly, founders are not looking for lesser valuations. I mean, I think some of them have a little bit of a come to Jesus and maybe even a fear aspect in that, you know, this is kind of a bad place at a bad time. There's the COVID issue that might be a risk to their long-term health, and then there's the aspect of a potential in capital gains doubling, which for a lot of long-term holders is a particularly impactful issue. And so that both of those have, I think, leavened the traditional kind of top of the market type expectations. But again, for those groups that are doing exceptionally well, they're expecting better numbers than they probably previously had. I mean, their growth has amped, their market share take has increased. I'm thinking of one particular client that's just taking over the world right now. So a lot of these, it's really it's a very wide split. But yeah, no, I would say that there has been a reality check for a number of sellers as far as valuation expectations.
And Lamar, from your standpoint in some of your portfolio companies, has the environment changed the prospects for them as it relates to bolt-ons or other vertical acquisitions?
Well, I'll preface by saying add-ons is never a huge part of our strategy, just because we are always backing an internal management team and not always fired up about the idea of rolling up an industry. But I will say the conversations where our portfolio company may have been having with competitors about this competitor wanting to retire and potentially looking at their exit opportunities, our direct outreach to business owners, we have seen a few, and again, I don't have great data to demonstrate this, but I can just speak to a few anecdotal conversations where business owners, fought through 0809, battled their company all the way back up, have managed to get through this okay, but this has, invited into their brain the idea that there are risks out there that I just can't foresee. And for that reason, and not to mention what John was talking about, the threat of taxes going up next year has accelerated a lot of these conversations with business owners who are saying, you know what, now might be the time. It's just a confluence of events.
A good question that just came in from Brian. Talks about, the level of preparedness and the ability to pivot was kind of across the board with companies. Some were, they didn't miss a beat. Others are still struggling to play catch up. So how have you all dealt with that, either in the your portfolio or, potential sellers or, deal flow of those that weren't really ready and they're still kind of struggling to catch up to this new remote environment that we find ourselves in, and how have you helped adjust expectations around that? So I'll toss that up to see who wants to maybe take the lead.
I'll just give you some input from my perspective, and I really think it's a reflection of the management team. Good management teams figure out, how to make hay during these times. We have a portfolio company that made assemblies for trade show space. Well, nobody's building trade show booths these days. They figured out a way to pivot and make dividers for temporary hospitals and for restaurants, and have done a terrific job pivoting. We have another company that makes precision parts. They were able to pivot and make ventilator parts for the significant increase in demand for ventilators. So really a reflection of the strength of those management teams and identifying opportunities to utilize their manufacturing space.
Let's kind of look forward now, and you all have touched in different ways. You've commented on some things that, as we all look forward, and Barry, maybe I'll stay with you as it relates to the financial markets. And you talked a little bit about the senior side of that and their focus around PPP and maybe covenant compliance and workouts. But what do you see as it relates maybe short-term, longer-term in the financial markets, and how that might impact this environment.
Yeah, I think fortunately the government put in place this PPP program, and a lot of middle market companies were able to take advantage of it. And I think it's helped a number of companies. And I think it's helped a number of companies that perhaps were weak going into this. And so I think over time, we would expect, bank credit losses to increase as the funds from these stimulus programs start to wear off, and now they have to face real reality. And I think that'll have a continued impact on leverage and pricing. I don't expect to see leverage multiples coming back, at any time in the near future. I would expect leverage multiples to stay low. I would say that bank lenders are going to becoming more conservative, and I think non-bank lenders who have their own credit lines and have to deal with reporting to their banks on credit losses, I think that will put a damper on non-bank lending as well.
All right. John, you mentioned in one of your deals that you were just on earlier, talking about the international, that was from a potential buyer perspective, but there's been this discussion of what does the international environment look like? Do we see a changing in the tariff outlook? Any thoughts in that space?
Well, I mean, we do have some clients that are affected by the tariffs. We have one who actually has production in China that is constantly kind of moving from one foot to the other with regard to classifications and such. They've actually had to hire an attorney specific to that task. And it's actually helped because apparently there's all kinds of back doors to these tariffs today. I don't know how much you guys are following it, but apparently you can get relief from the U.S. government in the form of actual grants back to you of how if you've been harmed by tariff impacts. So in some aspects, I think the larger clients are more able to navigate that. I think the other clients that are dependent on overseas supply from China have largely adapted pretty well, and a lot of supply has moved to other Asian countries, Vietnam, Thailand, even India. And, as a result, they've been able to handle those cost changes. Going from the European folks, we have not seen as much, of an issue with them. And I think it's largely because most of them have U.S. assets. So generally there's an aspect of being able to purchase from a U.S. base as opposed to internationally. So we have not seen, thankfully, knocking on wood, a huge amount of impact. Again, it still introduces an element of risk, which I think impacts valuation, but thus far it has not impacted the bottom line as much as we had feared for our clients.
So each of you in the last 45 minutes has touched on this little thing that's getting ready to happen in early part of November. And we kicked off convention season last night with the Democratic convention. So maybe, Lamar, I'll let you kick it off and we'll go around the horn just to get perspective of what you see, what you're seeing the impact today, what you see the potential impact as we move past Labor Day and race toward November with not only the presidential election, but the Senate election federally, and then across some states, what could happen at a state level.
I hesitate to make any predictions. Obviously, I don't think any of us want to do that. But I will say that generally our consensus here is that taxes are almost certainly not going to go down next year, no matter what happens in November. And that has begun to be reflected in some of the conversations that we've had with business owners and some of our direct sourcing efforts. Talking to business owners, there are some, more than one, that we've talked to in the past month or so that have said that they would really like to get a deal done before December 31st. So the biggest impact from our perspective is, and maybe this is glass half full thinking, but we anticipate there's going to be some element of our deal flow that comes as a result of people trying to race to the exit before the end of the year. If they want to run a broad process, that ship's probably already sailed. It would be difficult at this point to get it to market. But generally speaking, we think it might be a net positive to deal flow for the short term anyway.
Barry?
Yeah, I would add to that. I think the uncertainty over the election has caused an increase in deal activity. I think John alluded to that in his earlier comments, that you're seeing a fair amount of activity because of the concern over capital gains rates. And also, I think some people, maybe they came out of 08 and 09, the Great Recession, and now have come through this and said enough is enough, and let's retire peacefully. So that's been, I think, an increase in activity. And I think, given the uncertainty, I think those that are maybe on the sidelines are going to stay on the sidelines until there's more clarity.
John, you want to crystal ball the election, or you just want to add on to maybe what Lamar and Barry shared with us?
I'm not going to crystal ball it. I do think that it is got quite a few, of the more traditional family-owned / entrepreneur-owned owners concerned, just from a tax standpoint, if not anything else. And, and the worry is that, there'll be all the regulation that went away, in the last 4 years will all come rushing back. And there's a number of sort of, counter wins that are threatened. Who knows how many of them are realizable? I guess it depends on if the House moves, if the Senate moves, all that stuff. So, but I think there's enough risk in the air for sellers that it spooked them to the point where they say, let's pull the trigger now and not take our chances.
Before we kind of go to closing thoughts and comments, there's a new question popped up in chat around going back to process, and you all talked about some of the challenges and changes to the process as it relates to on-site. And the question was, because of those changes, have you found yourself using third parties to assist more in that process? Any thoughts around that? Any experience with that?
I'll just make a comment. We haven't minimized the amount of outside consultants we use. We always require a QV for any new opportunity, and we still require a QV. We would prefer that our QV partner visit on site and actually see the business. I think Lamar talked about that earlier. So we're not using less. I don't know that we're necessarily using any more than we would have historically.
That's the same for us. It's looking different, but largely the same loadout of service providers.
Yeah, from our standpoint, we are actually recommending defensive QV prior to launch. So, it's almost like having to hire a defense attorney these days, because guys like Lamar like to use those folks for offensive purposes.
Confirmatory due diligence. That's it.
John, how many? Just curious. I'll ask you a question. How many sell side, where you're selling a business, QVs, in terms of percentage, will you have done?
We recommend them to everybody, and it's relatively rare that they don't get done. Relatively small companies, they may defer. The some that are owned by publicly traded companies, like one I'm working with right now, will defer just because they feel like they have the defensive capabilities well in hand. But folks who have only been audited or even just reviewed, we highly recommend it. Just really because frankly, a lot of times we find additional add backs, EBITDA, bonuses that we wouldn't have found without the help of and generally we try and find a top 10 group to do the QOV for us. So the credibility helps too.
Hey, Brad, I'll go back to your question, and I answered it more along the lines of new deals, but I will say with our existing portfolio, these are unprecedented times, and people are having to deal with things that nobody's had to deal with. And so for some of our portfolio companies that are perhaps a little more troubled, we are encouraging them to seek some outside guidance from consultants, and we've done that in a couple of.
Okay, well, we're approaching the bottom of our hour together, and so I'm going to come back around the horn to all three of you and just ask for any closing comments, observations that you all would have around the topics we've talked about today, either looking back or looking forward, and then we'll turn it over to the breakout process. So, Barry, I'll come to you first.
Well, I don't know that I have any additional comments, but I will say, while these Zoom calls are nice, I sure look forward to the time where we can all be in a public gathering again and at an ACG networking event and shake hands and have a cocktail. So that'll be my closing comment.
It's a good one. Lamar?
Yeah, same. Deals are difficult to get done already, and we would love to have this additional hurdle of kind of jockeying around COVID and the pandemic out of the way. But that aside, we're pretty optimistic about what the rest of 2020 holds. So fingers crossed, though. This wasn't the first time I've been optimistic about what lay around the corner and been surprised by 2020. So who knows?
And John?
Yeah, I would take this opportunity. We can talk about some more of the stuff we spoke of earlier in the breakout, but I would take this opportunity to, put a plug in for ACG. I think it's still a very important network for all of us, and would encourage, especially the private equity groups and the lower middle market private equity groups, to continue their strong participation there. They are. Right, I'm on the national board, so I'm sort of taking this opportunity to make a little bit of a speech here. But they are working on and I don't even know if it's been disclosed yet, but I'll disclose it here. A networking / software CRM, and even it's going to incorporate some aspects of Zoom system that will allow ACG to really leverage its personal network and its conferencing abilities, both in person and through the internet. And I think it's going to be fantastic and very helpful to really allow all of us to use these kinds of opportunities to their best advantage. So look forward to that.
All right. Well, I appreciate the time that John, Barry, and Lamar shared with us and sharing their insights and perspectives across the ecosystem that ACG is designed to support. We've had well over 100 today join us in and out. Once again, I'd like to thank Jane, Marcy, and Terry, our administrators for our respective chapters. They do an incredible job on a daily basis. That's continued through COVID, and they clearly were the brainchilds behind this event and kind of behind the scenes have made this work. So thanks to the three of them.